All right, tomorrow will be the announcement by the Federal Reserve as to what they're going to do with the federal funds rate. We need to talk about that a little bit here and also take a look at what the banks are doing ahead of that announcement, which is kind of interesting here today. Today is January the 31st, 2023. It is now 4:03 p.m. Central Time. A little bit later in the day, but that's good because the bond market is now closed. The mortgage-backed security market is now closed for the day. So we can see how things have wrapped up here ahead of the announcement by the Federal Reserve. Now, the Federal Reserve meets with a couple-day meeting. I believe it's every 6 weeks that they get together. And they talk the first day, which is Tuesday, and they make the announcement on the Wednesday following. And that is going to be what is going to be happening tomorrow, the 1st of February. So they're going to announce any changes to the federal funds rate. Now, understand that the federal funds rate is not the mortgage rates. That does not mean that they're changing home loan interest rates. They're changing the federal funds rate. The federal funds rate is directly tied to the prime rate, which is something that everyday people, consumers will have really more effect by. So the prime rate is more directly tied to credit cards, some student loans, auto loans, and things like that, and especially home equity lines of credit. So if you have a HELOC or some other types of adjustable rate mortgages, sometimes that will directly affect that as well, the changes to the federal funds rate. Now, the Federal Reserve has increased the federal funds rate 8 times in a row. So the last 8 times that they met, they increased the federal funds rate. There was actually 4 of them that they brought it up by 0.75%, which is a very large increase for any one meeting and any one adjustment. Now, what we have seen is inflation began to show its face and it became a major problem and it hit hard. The Federal Reserve then tries to slow inflation by increasing the federal funds rate, which makes the cost of borrowing money more expensive. That's something that may not seem like that's that big of an impact to you and I, but this is also increasing the cost of borrowing money for businesses. And that then filters into the general economy and really starts to tighten the economy, squeeze the economy, and then slow things down, slow spending down. When you slow spending down, it allows inflation to come back down. Hyper spending creates inflation, which is what we saw after the federal government put out trillions of dollars through COVID relief funds and other programs. So now the Federal Reserve, in order to fight inflation, brought the federal funds rate up time after time, 8 meetings in a row. And now what we're seeing is it got to the top where they were increasing it by 0.75% each meeting. And then they had 4 of those. And then now they went down to 0.5% when they met last time. And now we're expecting them to increase the federal funds rate by 0.25%. Let me move over here. This time. And then hopefully either another 0.25% or 0% the next time. Now, here's the thing. I'm talking about increasing the federal funds rate. I have not said anything about reducing the federal funds rate. So if they go to a 0 increase, that does not mean that they brought the federal funds rate down. And that's what you're probably going to hear from the comments from Jerome Powell here tomorrow, is that he's going to only increase the federal funds rate by 0.25%, which is easing their efforts towards bringing inflation down. It's making a less aggressive move, but it's still a move. And you're going to hear him talk aggressively. So he's going to speak aggressively, that we are not going to let our foot off the gas when it comes to bringing down inflation. They are not going to let up on this fight. What they're talking about is they're not going to bring the federal funds rate down. Okay, so it came up. They're going to try to leave it here for a while before they start to bring it back down, because they want the effects of the moves that they've made to really set into the economy. And that is exactly what they should do. Okay, so in the past, what the Federal Reserve has tended to do is they rocket up the federal funds rate. They go way too far, and the market just absolutely gets annihilated. And then now they go, oh no, it's good. It's, the markets are just falling apart, and then they bring it down right away. or they bring it up to the point that they start to see the changes and they bring it down right away. So the fact that they're going to bring it up and leave it where it's at for a while to let everything set in, to let the economic indicators such as the PEC and the CPI come down to where we're closer to that 2% year over year core number, and then begin to bring the federal funds rate back down. Now that is kind of what they say, like a Goldilocks environment. Like that is going to be a perfect situation. They didn't go too high. They don't bring it down too soon. It's difficult to do, but that is at least what we want to see them try to do. So bringing up the federal funds rate by 0.25% tomorrow is what we want to see, but we want to listen closely to the comments by the Federal Reserve, because that's what's going to tell us which direction we're going to go. And we have a fight that we want to get into that we haven't gotten into yet. We want to battle with the 200-day moving average, and we just haven't gotten there yet. So today we're up 13 basis points, again, ahead of a Federal Reserve announcement, which is kind of interesting. We're down 4 on the 10-year Treasury as well, which is good news as well. Again, somewhat interesting being ahead of the Federal Reserve announcement and not necessarily what I would normally expect. So let's just see if I can make my mouse work here. Okay, so here we are in between our floor of support and our ceiling of resistance. And remember, we want to begin to fight the 200-day moving average. That is the fight we want to get into, but we have to break through this Fibonacci level here right above us at 101.671. We haven't even touched that for a while. Hopefully, after the comments from the Federal Reserve tomorrow and Jerome Powell, that we will begin to break through that Fibonacci level and start to have this fight so that we can start to get into the mid-5s on the Brent Bruce Daily instead of in the high 5s. So again, going into this announcement, where do you think home loan interest rates are? Now, traditionally, I would say that the home loan interest rates would probably be going up about 1/8 to 0.25% from where they were yesterday. That is because they usually hedge their bets, bring rates up just a little bit, just in case there's a surprise that they didn't expect. They were ahead of it on the pricing. The banks price their business on their own. This is not set by the government. So a bank, whether it's United Wholesale, Bank of America, Wells Fargo, Chase Manhattan, anybody else, they set their own rates depending on what they think is going to happen and the economists that are within their company. Okay, so what do you think that they're doing today? I would normally say that they're hedging their bets and that rates are higher. Interestingly enough, if we go ahead and we run the Brent Bruce Daily, it's a little different today and good for us. We are sitting at 5.999, a little bit better, about 1/8% better than we were yesterday, and have a little bit of credit of $137. This is with United Wholesale Mortgage, the largest mortgage lender in the nation. That is very common that bank is aggressive, but if you pay attention, they haven't been at the top for the last few days. It's been 11 Mortgage or Flagstar Bank. Those two have really tried to be competitive, and it seems like United Wholesale kind of backed off a little bit. But today, here they are, right at the top of the pack at 5.999. If we open this up here, what happens if we want to maybe pay a point? Let's take a look here. There we go. This mouse is not really working the way that I want it to today. Okay, so if you pay a point, you are at 5.75%. Okay. That is really the paying a point is interesting because that's where we were if we paid a point yesterday. So if you pay a point, you're at the same rate that you were yesterday. Why is it if you don't pay a point, you're at a better rate today? Well, this is what I think is going on. I think that United Wholesale feels confident that we are going to get a good report tomorrow. And instead of hedging their bets for something going wrong, they're hedging their bets for something going right. They're feeling confident that tomorrow is going to be a good day in the mortgage-backed security market. So they're pricing their business aggressively today because there's a lot of people that will be afraid of the news of tomorrow, and they will lock their rate today. So they say, look, I don't know what's going to happen. I don't know if rates are going to go up tomorrow. Lock me in today. Well, United Wholesale is saying for those people, we want them because we think that locking you in at 5.99 is not a losing proposition for us. We think that we're going to be able to take that rate today and that we will be in a position to be able to hedge against the mortgage-backed security market because they believe that interest rates are going to come down. 3 banks made that decision today. It was all 3, 11 Mortgage, Flagstar Bank, and United Wholesale that priced their business down a little bit today with only 14 basis points of the increase in the mortgage-backed security. That should be something to pay attention to because that tells you that all three banks' internal economists are feeling confident that they are going to see a good day tomorrow. We'll take a look and see. Let me know your thoughts. Let me know if you have any questions. Make sure that you like, subscribe, and share if this content is helpful to you. I know it's a little bit longer, but a lot to go into. We'll see what happens tomorrow. Have a good day.